I'm seeing a bottom forming on a very reliable, this is a gold company, mining company, and I'm seeing a bottom forming and an opportunity to get in on this. And so, again, I want you guys to, if you're new to these strategies, I'd love for you to paper trade them for a couple of cycles and see if these candidates would work for you. But what I'm doing here is I'm legging into either a covered call or I'm legging into a bull call diagonal debit spread. So what that means is I'm, instead of putting on the trade all at once, like a buy right or throwing the diagonal debit spread on all at once, I'm doing each leg separately. So right now we have an opportunity where we could either buy some of this stock or we can look for a stock substitute. And so I would go at least 8 months out in time, maybe this June 2024 option. And I would go pretty deep in the money on the call side. And what I'm seeing here is, even though I don't see much open interest, I am seeing a smaller bid ask spread. So you could probably set up this back month option quite well and get a good price for it. But you want to go far out in time and deep in the money if you're going to do that option substitute, or just buy the stock. Buy the stock in lots of 100. And that way you would then in the future be able to sell call premium against it. And then I'm just simply going to hold. I'm going to let that initial position appreciate as far as it is. And there'll be a level. And that level for me is $11 and actually more like $12. $11.50, $12, even $12.25. If I see the appreciation go past that, not going to worry about selling the call. I've got a directional position on my hands. I'll just worry about getting out and taking my profit and running. But if it reverses sometimes before then, I'm going to go through my process of creating an income trade. This is where I'm going to sell an at the money near term call, get some money in, and I'll buy an out of the money, maybe 3 to 6 month out in expiration protective put, which will protect my trade. And when those two trades are in place, that's when the income generating starts. I can actually, and it also is when the auto adjusting of this position starts. I can sleep really confident at night knowing that my portfolio is growing over time.
And this is a very nice price point for
Yeah.
the stock. And so, what minimum account would someone need to put this on? I mean, could you put this trade on for $1,500 or less?
Yeah. I mean, if you use that back month option, which is a little bit cheaper, you could probably, what you'd want to do is you'd want to do a good analysis of how much risk would be the worst case scenario. So if people wanted to analyze this on their own, analyze the risk associated with doing a buy right around the $10.50 zone. You can go back and you can look at some price action. Maybe you pull up the price bar from July 27th or even go farther back. I don't usually recommend this, but you could probably go back to July 11th and you can work on and say, what would have been a the risk associated with a buy right done at the money near term on that day. You can use any historical options lookup. And once you know that risk, apply that to your risk appetite. How much would I have lost in that worst case scenario? And how much am I willing to lose? And that you can work backwards into the size of your position. If you're doing a covered call, usually this could be around 30% of your portfolio. So it could be a pretty large position.